So we can keep the spirit of this conversation. Alison Tui is to my left, a senior vice president of the American Bankers Association. Dennis Kelleher is the president and CEO of Better Markets. Shamir, I'm going to botch.
It's all right.
Come on. Karkal. I can't. Shamir is a serial entrepreneur. He founded his current founding company, Scylla, and also founded Simple. For those of you who know, is one of the largest fintech providers, who was subsequently purchased by BBVA. And so, I asked you guys to come here and react to the chair's speech. So what'd you think?
Loved it.
Why?
I have not heard every speech by every regulator in the US in the last few years, but I do think this has to be one of the first times I have ever heard the head of a regulatory agency say that one of their priorities for a rule or a regulation was going to be promoting innovation. I think it doesn't get said enough. The US is not just falling behind on innovation, it's actually already fairly behind, and arguably has the worst banking and payment system in the developed world. And it's unless the regulators really get behind supporting folks like me, I think it's just going to continue.
I think we need to turn the volume up here, both
People are indicating
from a tech perspective. Somebody can turn the volume, and then
Hello?
Dennis, if we need to turn the volume up, let me turn to you.
Look, on high tech, you'd think the speaker system would work, wouldn't you?
Oh, I can project.
Look, I don't want to be cast as a Luddite here, but a couple of observations. And I appreciate the work done by the FDIC, and I really appreciate the breath of fresh air that Chairman McWilliams has brought to the agency and an openness, and I really have enjoyed working with her and the staff at the FDIC. But I think it's important to go back to first principles. And we're talking about the FDIC, the Federal Deposit Insurance Corporation. It's not the Banking Bureau for Innovation, Modernization, and Competition. Right? Its mandate and responsibility are not maximizing the profits of the private sector. It's not. Innovation and modernization are too often just siren songs that end badly for investors, taxpayers, and safety and soundness. Everybody loves innovation. If you call it new, we got to be for it. People sometimes think it's a synonym for less risky, when in fact, new is often a synonym for more risky. And those new risks are often unknown, and particularly unknown at the beginning, and they don't materialize until long after the profits are pocketed and taxpayers are left with the bill. Think about this, when you're talking about innovation. Brokered deposits were an innovation in the 80s. They were an innovation. They were new. They were exciting. They were high tech, actually, at the time. And look what happened to them. We could use other examples. CDS and naked CDS, great innovations.
Credit default swaps.
Credit default swaps, and naked credit default swaps, CDOs, collateralized debt obligations. I know we don't want to use acronyms. And synthetic CDOs, great innovations. I mean, you look at these things, innovation in and of itself, the claim of innovation, a technological change, and new products are simply not a basis to discard carefully crafted and critically important financial protection rules. Another first principle. When you talk about a bank, you're talking about insured deposits. They're IDIs, insured depository institutions. It's a privilege, not a right, to deal with a bank. And with those benefits come responsibilities and, yes, rules. Remember, I'm going to read this because I'll get it wrong if I don't. Every single FDIC insured bank has a sign that says what? Quote, your deposits are backed by the full faith and credit of the United States government, close quote. That's what makes it different, and that difference makes all the difference. So there are a lot of financial institutions out there. So you can innovate, you can do whatever you want at the entire non-bank financial sector, which is bigger now than the banking sector and ridiculously unregulated at the moment. I mean, FSOC has put up a going out of business sign. So FSOC's job is to regulate non-banks. That's zero now. There isn't, in fact, there is not one systemically significant non-bank in the entire United States today. And if anybody knows what the non-banking sector looks like, that's absolutely laughable. So you could go to money market funds. You could, if you want to use all this type of innovation that you want to use with insured depository banks, you could go to money market funds, mutual funds, hedge funds, private equity funds, all the other financial institutions out there. But that's not where this is focused. It's all focused on the insured deposits. And that's because people, customers, prospective customers, want the safety, soundness, and security that comes with the insured deposit. But that's, it's not a one-way street. The one-way street is you socialize the losses while you privatize the gains. You want the insurance and the uplift from the insurance, but you don't want the restrictions that protect the taxpayer and the system. And so what you have, in our position, we're not for or against broker deposits. We're for prioritizing the protection of safety and soundness, the DIF, and taxpayers. That has to be the overriding objective. And I have to say, in all candor, I was quite surprised that that was the third of the chairwoman's 4 goals, protecting the DIF. For the Federal Deposit Insurance Corporation to have the third goal, protecting the DIF, is really, people should take note of that.
All right, let's get to the other.
So the bottom, to me, the bottom line is the test has to be, so whether or not any of these particular changes are good or bad, I don't have a position on. But what you have to do is you have to have an analysis that's unbiased, based on evidence, data, and facts that are publicly available and independently tested. And if you look at what's being proposed now, I don't know what comes out tomorrow, in the ANPR, it's hard not to conclude that the changes are unjustified, unwise, and untimely, given where we are in the business cycle. This is the wrong time to start increasing risk of the DIF and the insured depository institutions.
Okay. So also, I'm going to ask you 2 different things. First, getting back to the chair's speech. And second, I'm going to ask you to kind of respond a little bit to Dennis's comment. But let me first what did you think of the chair's speech?
Well, we're very encouraged about her leadership and her proposal. Can you hear me now?
Still no.
Try it loud.
Am I talking mine?
Well, now mine works.
Okay. I'm sorry. Thank you, Dennis. We are very encouraged by her
The ABA
leadership.
and better markets are like this all the time.
You could have fooled me.
We're very encouraged by her leadership. We appreciate her leadership in this on this issue as well as on other issues. Dennis, I think we can, we can both agree she is a great leader and a breath of fresh air. With respect to broker deposits, I think in her speech and in her conversation with Aaron, it really highlighted that this isn't a simple issue. And I think that there are some that make the mistake of, we are introducing risk to the deposit insurance fund, to the FDIC. If you look at the 1980s and the banking environment then, and the small slice of funding that Congress intended to isolate, what is encompassed in the definition of broker deposit is way beyond that. And it affects the 5,000 banks in this country. It hits every bank differently. It hits different banking business models differently, different consumers differently. And it's really opaque, and it doesn't achieve any clear policy goals. So we are very, happy to see her leadership. I look forward to reading the proposal. Obviously, there are a lot of details in that proposal that we need to consider with our membership. But I think it goes a long way to really, again, isolating a specific type of deposit that was meant to be isolated instead of this massive sort of hodgepodge of funding types that is nonsensical. There's no logical rationale for why these are classified as higher risk, when in reality it's just a different mechanism for raising deposits.
So hold on, let me pin you down on that, because there are 2 different questions. One is the definition of broker deposits incorrectly sweeping up too many things and categorizing things as risky? Here, I think we're getting you a handheld.
Thank you.
Your mic is on, but just use this one.
Okay, thank you.
And so that's kind of point 1. Sub-point 2 on that is that the same things are being treated differently between different institutions, right? And the chair kind of made both points. From your experience in the nexus of all the institutions, right? Because have you guys seen that? That within institutions, within different banks, they're getting kind of slightly different rules on similar things. Sometimes it's a broker deposit, sometimes it isn't.
I have. But you should answer the question. I don't want to mansplain here.
Well, I think, yes, there is a gray area. Is this not working?
No, it is. You just got to put it right up.
Okay, so I think there are a lot of gray areas. There's a lot of regulatory uncertainty, so that yes, there's a huge amount of inconsistency. And to your first question, absolutely the definition of right now, as the FDIC has interpreted, where it currently stands, is it sweeps in a broad amount of products, deposit products, and it's not a helpful isolation or calibration of risk. It's just, again, a nonsensical hodgepodge of deposit products that there's no rhyme or reason as to why they are stigmatized, why banks pay more. It's about how the deposit is gathered as opposed to the risk that they actually pose. I think another sort of misconception is that Section 29 is not and was not meant for to be a proxy for liquidity risk or interest rate risk. And some people sort of view it as that. That's not what it was meant to be. Again, it was meant to isolate a very small, distinct product type, and it was meant to, prevent troubled institutions from holding that very distinct funding type. Now it is impacting well-capitalized institutions. It's impacting consumers. And it's sort of like has such a broad approach. And again, it's a very arcane issue, so it's very behind the scenes. But it has a great impact and is prohibiting banks from serving their customers the way they want to be served.
Shamir?
Oh, I don't even know where to begin. I think Paul Volcker just passed away a couple of days ago. And I think at the end of the last crisis, he famously said that there's been no good innovation in finance since the ATM, which came out in the 60s. So he discounted everything in the 70s, 80s, 90s, and 2000s, right, up until 2008. And there's this approach that some people in the startup industry take, which is that all innovation is good innovation. And yet I think Dennis here falls into almost the opposite trap, which is to look at all innovation as the same and say it's all bad. And I'd actually like to distinguish between two types of innovation here. And it's always hard, but perhaps the best way to characterize it is if it's innovation by people in suits for other people in suits, it's probably bad. And if it's innovation in people in hoodies for people who struggle to buy clothes, it's probably good. And I think the problem we have...
I'll let you off the question of what happens when suits come up with innovations for people struggling to buy clothes, but
that's called the payday loan industry. So we've seen that too.
Or overdraft.
Well, that's the problem we have. The world is not that simple, Dennis. The world is amazingly complex. And yet, we have a 30-year-old rule which tars all of those types of innovation with the same brush. And then, as Chair McWilliams pointed out, also takes what looks like exactly the same thing and treats it different. So let me give you a concrete example. And I think one of the gentlemen back there commented that he'd represented banks and broker-dealers. I actually have started both of those. And the last bank that I started was a neobank. In 2009, we couldn't get a banking charter because the FDIC had a close for business sign outside. And so we had to go partner with an existing bank. And by the way, the story I was told was that was the wrong time for innovation in the financial services industry because we were deep in a recession and just coming out of the last crisis. We're at the opposite end of the cycle now, and I'm told it's still a wrong time for supporting innovation. So somehow this never seems to be a good time to support innovation. But we couldn't get a banking charter, so we had to go partner with an existing bank. And then that didn't work very well. So we ended up being acquired by an existing bank and became a wholly owned subsidiary of a chartered depository institution. And then found that as a wholly owned subsidiary, which had no technical or legal way of putting its deposits anywhere except at its partner banks, those deposits would be treated as brokered because we were a subsidiary, 100% owned. The same situation now, and that's simple, by the way. I believe, as far as I know, I haven't been involved with it for the last 2 years. I believe all of its deposits are still treated as brokered on BBVA's balance sheet. Good news, BBVA has a massive balance sheet. That's a problem because those are growing, but that's not yet a problem that's broken anything.
So, Dennis?
Oh, well, hold on.
One second. Let Dennis,
There's an opposite point too, right? There's another company called Aspiration, which to every customer who uses it looks exactly like Simple, offers all of the same features, some better, some worse, in an app, and is also a startup. But I believe, I don't know enough about it, but I believe that they are a broker-dealer who now places deposits at multiple institutions using Promontory's deposit spreading product, which is completely controlled by Aspiration, could switch from one bank to another depending on interest rates, and is not treated as brokered deposits because of the reciprocal deposit definition. And I don't know anything that's more ass backwards than that under this rule.
So there's a debate from the audience about whether or not it is. All I know is I'm a customer of Aspiration, and when they had to change their debit card issuing bank, it was not a great, I mean, they handled it very well, but from their institution's point of view, you don't want to go through that with your customers.
Been there, done that.
Dennis, there are a lot out here.
I won't
respond.
Pedantically mischaracterize what you say or make assumptions about you based on your clothes.
Touche.
Although I'm quite delighted, if you want to lump me in with Paul Volcker, I should be so lucky. I'm about
would
as
all be so
unworthy as I would be lucky. I'm not against innovation, and I think that that's kind of just a silly thing to say. The United States of America wouldn't exist without innovation, without entrepreneurship, without capitalism working, ideally democratic capitalism that works for broad-based prosperity rather than as a wealth extraction vehicle only. But the issue here is you can innovate. Anybody can innovate all they want. If you want to innovate and where it connects up to insured deposits, when it puts at risk the full faith and credit of the United States, when it puts at risk taxpayers, then you know what? We're not going to sit back and say, do whatever you want. Take your hoodie, take our money, good luck, God bless you. They ain't working that way. You want to work that way? Stay away from money that hardworking Americans support a financial system. It's a little over 10 years ago, and it cost those hardworking Americans, I don't know, a couple of $1 trillion to bail out a financial system. And so that's why it's called the Federal Deposit Insurance Corporation. If you want unreserved cheerleading for innovation, which I'm for, go to the Department of Commerce. If you want to do it in foreign lands, go to the Department of State. There are a lot of places where unbridled support for innovation and entrepreneurship can be supported. I mean, that's great. And the only thing we're saying is that when you want to couple that innovation with insured deposits and insured depository institutions, then there ought to be a process, a rigorous process, a data-based process, an evidence-based process that actually prioritizes the statutory mandate for that institution, the FDIC, which is safety and soundness that protect the deposit insurance fund and taxpayers. Now, my view is that you can have both, and we should have both. The financial system needs innovation, desperately needs innovation. The barriers to entry, the concentration, the oligopolies, we're for all of that. But it's not one or the other. It's not one extreme or the other. And with broker deposits, pretty interestingly, what we're trying to do is draw a line between, for lack of a better phrase, sticky deposits and super hot money. That's what we're trying to figure out, right?
Totally.
We could call this core, we could call this brokered, however you want to do it. And the problem with the argument put forward by some about the statute in Section 29 is it was not meant to be something in amber that looked back only and said what we don't want is that last crash, and we don't want CDs in this amount being bundled and moved this way. That isn't what Section 29 of the statute was about. The FDIC and federal regulators were working with this issue since the early 90s, as we know, and as the D.C. Circuit decided in 94 they couldn't, 84. And so what we have is actually a statute that actually was addressed to this spectrum. And it addressed it in a way that gave fairly broad-based authority, statutory authority to the FDIC to draw that line. And people don't like how it's drawn, and it may be totally meritorious, right? If it's ad hoc and opaque, bad. If it's, takes too long, bad. But if in fact it's rather a case-by-case analysis because it's a product-by-product analysis, then that's probably good. And so I think just saying the statute doesn't apply, it's opaque, we need innovation, and therefore let's do X, Y, and Z is only half of the analysis. That's really the point.
Well, so I guess I would ask you then, the current interpretation includes, the spectrum of sort of enhanced risk deposits. It includes what we can all agree are stable deposits, but that means different things for different institutions. The implications of what happens if you fall below well capitalized in an environment where everything is a brokered deposit, to me, that puts the fund more at risk because you've created a massive funding liquidity crisis in the event of widespread issues through the industry. And that isn't good policy in my book, right? It's better to isolate the risk and have specific goals that you're trying to achieve. As you noted, it's bad to be ad hoc and opaque, and that's exactly where we are. There's no rationale for the funding types, mechanisms, and products that are in the current bucket of brokered.
So let me drill down on that, because there's a quote from MasterCard, who had a very interesting comment letter on this, because they're both deal with the prepaid space and the HSA. And I didn't fully appreciate, HSAs didn't exist when this rule came out. Whatever you think of their policy, you put money away. If you're wealthy enough, you get the richer you are, the bigger your tax benefit. And you can use this money for healthcare. And this was MasterCard. And then somehow these are considered brokered deposits. MasterCard wrote, both prepaid cards and HSAs are associated with a significant infrastructure, forcing banks to make a considered judgment whether to enter the business and making it unlikely for a customer to move funds. Moreover, these products serve distinct purposes for consumers other than an investment purpose, and for banks other than deposit generation. Indeed, prepaid cards and HSAs often do not pay interest. I think that's pretty much the norm on HSAs. Is that on the right or wrong side of this sticky deposit?
Well, if I may, I think HSAs are one area where it's gray, right? Nobody knows, and different banks and different firms and have different interpretations as to whether that HSAs are brokered.
So how would you draw it? Where would you put
depends.
HSAs on the line?
Well, it depends. I would put them under the employee benefits exemption. There are several exemptions.
So you would exempt them from being brokered as an employee benefit?
Yes.
Going down the line? Okay. Where'd you guys put them?
I would put them probably more towards the sticky end of the spectrum, but it really does depend on the contractual kind of clauses and by the way, I agree with the characterization. There is hot money and there's sticky money. There's a spectrum in between. I wouldn't put HSAs all the way on the left. I'd probably put them left.
And what would you have if you were the chair of the FDIC? Would they read contract by contract? If you put this in your contract, you're sticky. If you put this in your contract, you're not? Is that what you're saying?
I think under existing regulation, I don't think there's any other way.
Right, but under this new rule tomorrow, the FDIC is going to change it tomorrow.
I think they would still have to do that. They'll just do it much more transparently than they have done in the past. What I really liked was Chair McWilliams' approach of saying, let's ask Congress to write a law which says, let's not get into that. The problems in a bank, as far as I've ever seen, usually start on the asset side. And let's look at that. And if you're undercapitalized, you don't get to do fast asset growth. And that really solves your problems much better than trying to differentiate between sticky and hot. But if we are going to do that, then we can do it much better than we currently do, which is draw a line and try and put things on the left or the right based on some 30-year-old definition. I mean, 30 years ago, the entire U.S. banking industry had less computing power than this phone.
Dennis, where would you put it?
I would like to start by saying, I hope people notice that they both actually agreed with the analytical framework I proposed.
Yes.
And the truth is, there isn't, and you know this, Aaron, and I appreciate the question, and I really do appreciate Brookings doing this, and it is a reason why they're here and the program is here. But when you talk up here, you can say also, but HSAs, Well, there isn't an answer. You can't say HSA this or HSA that. It belongs here, here, here on the spectrum. You actually have to look at the particular program. So is it an HSA where the sponsor of the HSA keeps all the money and I'll make it up, it's $1 billion, and it sloshes in and out of an IDI every night? I'm making that up, right?
Yeah.
I don't know. Is that the circumstance, or is it not? Is it like sticky money? Do they, in fact, do the individualized accounts that build relationships with particular IDIs, and therefore they sell them other products, and they actually are broad-based customers? I don't know.
I think sometimes when you get this card, you get locked in, right? Because I get this debit card when I've had an HSA. I've not had a great experience. You get this locked-in debit card, and then you can use it some places, and then you have to send some crazy amount of paperwork to justify that when I went to CVS, I was using healthcare and not buying candy.
But from a liquidity perspective, though, if I'm the HSA holder, I have a direct relationship with that bank. As I understand it, I don't have an HSA, but as I understand it, it's my decision to either bank with the bank that my employer originally recommends, or I can move that account to a different bank. That's not a brokered deposit. And my choice in banks that offer that service is dependent on how, broker deposits are defined and stigmatized, and what other institutions want to offer that product. So my choice is ultimately limited, right, by regulations that don't reflect the actual marketplace.
Would we all be open to an idea whereby there could be some definition of these contractual relationships where the HSA providers could know a priority whether they'd be considered or not and make a decision? I mean, is that because we want to get away from this ad hoc, non-transparent? That seems universal.
Yes.
I think, too, back to the point about, Chairman McWilliams' recommendation on the asset side. Historically, the asset side is where the problems are. We have capital standards now. We have capital framework. I would agree with the approach. It should be funding agnostic. Funding is so different and poses different risks. It's almost on a business model, institution-specific basis. And many institutions that have what are perceived as risky funds manage those risks and mitigate the risks so that there's no problem, and that focusing on asset growth and limiting troubled institutions' asset growth seems to be a much more simple way of looking at it, instead of torturing ourselves into this, what funding product in what situation would be brokered. That's just a complex web that you don't want to get into.
And especially if an institution in trouble was funding its risky asset growth with some other type of short-term lending, which was not brokered deposits, and we completely eliminated all brokered deposits in the system, those institutions would just go to some other funding source and try to grow out of their success that way. So the real problem here, I think, I like Chair McWilliams' approach, which is the problems are on the asset side. Let's manage that. And if the institution wants to go do brokered deposits or it doesn't, as long as you manage the asset side well, the funding sources matter less.
It's a belt and suspender system. It's not one or the other. It's all. And we actually have, when I say we, the FDIC and the other banking regulators have an army of supervisors who are out there working on, or supposedly working on, not working on is the wrong word, supervising the activities of the bank writ large, including on the asset side. And so it's a little bit, we're talking about one tree, brokered deposits, in a big forest that has a lot of moving pieces and a lot of parts. And so I think obviously we're focused on this because that's the rule and that's what the chair talked about. But I think we need to open the aperture to look at, before we start acting as if this is the only thing there is. And you're right, they will move to other. If you say you can't do this, then they will do what they can do.
Somewhere else.
Or maybe they'll do that anyway, and they'll, sometime in the future, another banker will go to jail for breaking the law. Don't hold your breath.
Yeah.
But so it has to be both. There has to be attention paid to the asset side, management, board oversight, et cetera, and there has to be actually application of the law. There is a law here, and hoping that Congress is going to actually pass a law on anything other than the Senate confirming a judge is a fool's errand at the moment. So I think we have to deal with the law as it is, and we have to deal with the regulatory structure as it operates in the real world, which is multifaceted.
But the law is based on a poorly worded statute that was geared towards a 1980s view of the world.
But
right?
It's a 1934 Act, a 1933 Act.
Hold on, let Allison.
Well, but Section 29 was in the 80s. It was originally written by the FDIC as a rule, and then, Congress sort of copied and pasted that over. But I think about, my father at that point was close to my age. He went to his bank branch to deposit his paycheck. He wrote checks to pay, and put it in the mail to pay for his electricity. He got his, every morning he went out in his bathrobe to get his newspaper. And then I think about my son, who's 14, who has never been in a bank branch, wouldn't know what to do with a check. And when he gets his first job, the banking system has to be able to accommodate my son, who is used to automatic transfers, refuse to take his allowance in cash. They can't. The banks won't survive if they're
mowing his lunch.
If they're
Maybe by the
if
way,
they're looking
maybe
to my father's banking world, his grandfather, it's not the way for a healthy banking
hold on one
system.
second. Maybe by the time your son starts college or graduates college, the Fed will
It
actually
gets a job.
the Fed will actually have processed that check any faster.
Allison, your son, at 14, it's possible he may never walk into a bank branch.
Right.
And I don't think, I think that's a great world. I'm personally not a fan of bank branches. If some people want to go to them, that's fine. I do agree that the statistics probably show an age correlation, but in the first 6 months of launching Simple, we had a 97-year-old customer who signed up. And he actually broke our KYC system because he was born before the Social Security system was launched, and so it kind of caused some errors. And we figured out how to fix that. So older Americans actually hate branches even more because it's what they're used to, but actually getting to a branch can get hard when you're older.
But there's no different risk between my son's approach with the app on my phone, which is how he gets his access, and my father's approach in the 80s going into a branch. There's no added risk to the.
So let me ask one more question, then turn to the audience to jump in here. But I do think it's all easy to say the problem is just on the asset side. Don't worry about it as long as we get the assets. Well, I have a bunch of assets. They're rated AAA. They're in this complex security, but don't worry, I have insurance from AIG. If the security goes under, I'm completely covered.
This sounds familiar.
Yeah, right. And by the way, that was a story that was told the last 2005, 2006, there were no bank failures. Everybody looked like they had these fantastic assets. Their balance sheet was spectacular, and they had these liabilities, but don't worry, they're off balance sheet, and they're not in the IDI, and blah, 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 and kaplooey, right? And so, hold on. So we do need a bit of a belt and suspenders in terms of activities. On the other hand, I think there is a fair point that HSAs didn't exist when they were thinking about this. That contrary to the point about the nominal interest rate, it doesn't matter if I'm chasing 10 basis points of yield from 1.5 or 7.5. If I'm chasing 10 basis points of yield, I'm chasing 10 basis points of yield. If corporate treasurers do that all the time at very, very low nominal rates, and when they run into trouble, there's a cascading effect. And so I kind of want to ask two different questions here. Shamir, you built a fintech company. You built the company on the existing broker deposit rules.
Yes.
And whatever the costs and problems were, it didn't deter you from building that company, launching that company, and having that company be successfully acquired, right?
Yes.
It happened.
Yes.
So this kind of begs the question, and drills in a little bit. It's not about not preventing innovation. Maybe it made your innovation more costly. Maybe tell me about how the existing broker deposit rules impacted the building of your company, because it happened, right? So why do we need to fix this or not, or what were the ramifications? This is a unique perspective.
So July 17th, 2009, a classmate of mine from business school. And by the way, before I started Simple, I was a consultant at McKinsey. My last two major projects before this July 17, 2009 were resolving a $1 trillion bankruptcy in Europe and working on a country bailout plan in the Middle East. So I am somewhat...
So you almost disclosed your McKinsey client so you can run for president.
I am not close to them anymore.
That's what he says.
I am, well, I don't think...
Sorry.
I'm banned from running for president in this country in many ways. Most importantly, by not being born here. So I was much more familiar with the traditional financial system and kind of the massive mess that was 2008 and 2009. And then this classmate who was a startup guy sent me an email, and he was a friend, and he's a friend, and said, let's start a bank. And I was like, my immediate reaction was like, what the hell has gotten into Josh, right? And then I thought about it, and the vision he laid out was so much better for end users and customers, right? Like that's where he started from. He didn't think about the back end. That it was just so compelling that I started talking with him about it. And fast forward, to like November of 2009, and we quit my job, moved back to New York, and started up Simple. And I pulled the McKinsey deck, and I was like, how do you start a bank in the US? And it was like, you take $10 million, a few computers, go to Utah and get an ILC. And it was all laid out there. Guess what?
ILC is an industrial loan corporation, which is essentially a loophole in the exemption between banking and commerce.
Yes, and guess what? That was not an option in 2009. It was not an option, I believe, between 2009 and 2017.
Even before 2009.
Yeah. In fact, every year between 2000 and 2008, there were between 100 and 300 new banks chartered in the US. Between 2009 and today, I believe there have been 7, and there might be one more which the FDIC is approving. Of those 7 or 8, I think only the last 2 I would characterize as anything new. The remaining would look would have looked exactly the same in the previous 2 centuries.
Tell me how broker deposits impacted your...
Sorry. So the way broker deposits indirectly and directly impacted it is it took me 3 years from that email to launching Simple. Now, to people in the financial world, 3 years to build and launch a bank sounds really fast. To people in the venture capital world, it sounds like insanely slow. And so it's not like I'm the only one who could do this, or me or Josh were the only ones. Like, we were the only ones insanely determined enough to keep bashing our heads against the wall until the wall collapsed, right? Or we got through it. And that's what's changed between 2009 and now, is that by finding a way through that regulatory mess, other people are like, well, we can do that, and we can do that better. If Josh and Shamir can do it, then I can do it. And that's why there's now, I don't know how many, 20, 50, 100, Raj probably knows, like how many neobanks and variations of neobanks, the entire fintech industry. It was, back then it was like Lending Club, Betterment, and Simple, Square, and that's it. Maybe a few others. And now it's like there is, I think, 8,000 fintechs. And all of that is kind of because somebody made their way through and blazed a trail, right? But if you could take that 3 years and make it into 6 months, there wouldn't be 8,000 fintech startups. There might be 80,000. The amount, there are, 2 million apps in the App Store. That's because it's so easy and quick to build an app. I don't think we'd want 2 million fintechs, but I think we can do a lot better than what we have right now.
Okay. We'll start in the back, and then Bert, you'll go next.
Oh, thanks. It's a terrific program. I'm Carl Polzer. My little project is a center on capital and social equity, and I'm a generalist. My concern is really protecting the little guy, including the little guy, and having a stable system. So when I took financial management, budgeting, and control at the Kennedy School like 30 years ago, I remember that when you move liabilities around, there can be effects or countervailing. The physics changes the assets, can change the assets, net assets. Also, so my question is, who's watching and accounting for what's transacting here, either through the brokers or between banks when they, move liabilities or, and who's making sure it all adds up to 100%, not 200% or 300% or 400%? In other words, they're not leveraged. When the stuff moves around, it's not being leveraged or hedged or sold 3 times like we had with the last. And how do you limit that? Does that make sense?
Sort of. So let me start with your comment about the little guy, right? And I think part of what we've all talked about here for the past 2 hours is that this isn't a simple question. There are many complexities here. One being the low and middle income contingent and the underbanked. And I know, of community banks that are small that serve lower income areas, that their demographics of their community, which they serve, is such that they need a lot of loans, but they aren't wealthy enough to fund those loans. So the community bank has to go outside of its local area to fund the loans that the community needs to grow and thrive. And the way that many banks do that is broker deposits in the truest sense. However, as has been noted, broker deposits maybe don't pose the same risks that they did. They're less expensive and more stable in many cases than they were in the 80s. So they're a tool that's being used to support underbanked and lower income communities. With respect, I think you're asking about the deposit brokers themselves and how they're regulated, which that's outside of my scope. Maybe others have thoughts on that. I would think maybe that's a FINRA issue. It's sort of outside of the banking regulatory space. But banks also have capital and, are highly regulated. So from the bank safety and soundness side, I think that they're protected. I can't answer to the deposit brokers and how they're regulated.
I'm not sure I understood the question, but at least I think it was specifically asking about transaction monitoring and sort of basic accounting in the non-bank space. Now remember, fintechs are actually a very small chunk of the non-bank space. Non-banks is a very large, and there's all those like SPVs and all the other kind of acronym soup of the pre-crisis didn't actually go away. It's still there and it's still pretty big. At least within the fintech world, I think it's clear to at least all the entrepreneurs and tech folks that I know that everything from the Bank Secrecy Act to the Patriot Act and all the intermediate regulations actually does apply. And even the folks in the crypto world who might have thought that it didn't apply to them, I think they have been disabused of that notion. And so every startup I have invested in or been involved in had a compliance officer, a compliance policy, knew how to do its AML and monitoring. And in fact, in many cases, most of those startups did it better than many banks. And in fact, they did it better because they use technology natively. And so a lot of transaction monitoring is quite amenable to technology-first approaches, surprisingly. Accounting, for that matter, it's really a function of ultimately, the only institutions that get access to the payment systems, whether it's Fedwire, ACH, or the check clearing, are depository institutions. So all of this has to go at some level through depository institutions.
Or the real-time payment network that's been built external from the Fed and is actually technologically more advanced.
It is still clearing through Fedwire, though.
Yeah, no, that's
settling through Fedwire, I should say.
Which slows it down.
The other thing I'd say is, thank you for what you're doing. And starting with your initial comment, which is you're looking out for the little guy. Nothing happens in Washington, or I should put differently, everything that happens in Washington is claimed to be for the little guy. Almost none of it is, except when they're on the receiving end. And so the last statistics I saw, and somebody here can correct me, is roughly 48% of all broker deposits in the country today are concentrated in the 4 largest banks. So,
it is broker deposits, I believe, are more concentrated among larger financial institutions.
This is true.
But how
and it gets to and the statement that community banks in unserved and underserved areas rely disproportionately on broker or deposits from outside their area. I see that mentioned all the time. I see very little data put in the record on it, including on this ANPR. The statements are made, but I haven't seen the data. Nobody put the data in that I'm aware of.
Have you read some of the comment letters? There are a lot of community bank comment letters.
Well, I've only read a few of the 130.
Okay, well, I'm happy to point out the ones.
But the 4 from the ABA I read. So, among others, in the MasterCard one, and Bert's comment letter, I could go through the audience, actually. But I'm just saying, I would like to see a lot more concrete data associated with these changes to benefit the little guy that actually shows any nexus between the purported change and the benefits that are going to be showered on the little guy. I'd like to see a lot more data on that. I'm not saying it isn't there, and I'm not saying they're all bad and it's all wrong. I'm just saying merely because it's said it's for the little guy may or may not bear any relationship to that objective, and often it's not the case.
And I would note, too, that the call report data on broker deposits, given all that we've discussed about how broadly it's interpreted, how inconsistently it's interpreted, that one line item in the call report isn't always accurate or indicative. of the real story. And I'm happy, Dennis, to note in our response to the FDIC and our comment letter, all the community banks and their funding and how they help their communities. And thank you for the reminder that that needs to be highlighted. And I will remind my community banks that are very actively involved in this issue to comment.
And I've read the ICBA letter.
We got Bert and Raj, because
Thank you, Bert Elia, banking consultant. Dennis, question for you. The chairman or chairwoman talked about the role that growth plays in and rapid growth in failing bank institutions. My question for you is this: what are your thoughts, pro or con, with making the rate of growth a more explicit factor in how risk-sensitive deposit insurance premiums are calculated? That is, should a fast-growing bank pay a higher rate of premium than a slow-growing bank?
Bert, you're a bigger expert on this than I am, but we both know that merely looking at a rate of growth tells you very little. It's the composition, concentration, and activities associated with the rate of growth, and it's both. You've got to look at the asset side and the liability side. And so it's the full balance sheet you have to look at and the complexity of what the particular institution is doing and how it's doing. If it's a single institution that's growing based on shopping mall funding in the Dallas area in 1989, that's very different than a financial institution growing at the same rate that's geographically diversified and product diversified. So this, as you know also, is supposed to actually be captured on, I don't know whether you want to call it the more nuanced or the more tailored supervisory side of our regulatory system. And so it already should be a material part of the regulatory architecture and the outcome of that, which is to say, you brought up a good point that I think everybody agrees with. Part of the problem is you have this cliff effect. If you all of a sudden become less well capitalized, you can't get broker deposits, boom, there goes that funding source, and then where do you get it? What do you do? My answer to that is that really says nothing about, or my view would be, that says nothing about the broker deposit rule. That said, I would say, where are the supervisors 6, 12, 18, 24 months before they're at the point where they're bang less well capitalized and the broker deposit option is not available. So I think it's much more complex than saying like yes or no, look at assets, don't look at assets. They're looked at carefully, and they're calculated carefully in terms of the overall risk assessment.
And we agree that it should be a holistic balance sheet approach. I think we can come into agreement there. It's not just one source of funding. It's how a bank funds itself, what loans it's making, and how it mitigates any risks on either side of the balance sheet. And, of course, its capital position.
Right. Yeah.
So,
Raj? Or do you want to?
could I ask a question?
No, let's let Raj go first.
Okay.
And then, Shamir, you're up next.
Thanks, Aaron, for hosting this immensely boring topic, but is actually quite important. I would have thought prior to this conversation, based on whatever number of years now I've wasted in this one industry, that over the course of that time, one of the things that has changed for the better in terms of prudential regulation is is a better focus and more calibrated focus on the stability of the liability side of the balance sheet. It's not all about assets and the tyranny of double entry accounting. And as every crisis teaches again, like in a crisis, your assets, your liabilities, and your liabilities, your assets, it matters. But given this focus on stability of liabilities broadly, I would have thought that this sort of definition of what's a broker deposit, what's not, would have become a dead letter by now. But rather, we should be more focused on potentially broker deposits being a symptomatic of macro prudential concerns. In other words, as the curve steepens and you're kind of at sort of the height of things, like should one be concerned that this allows like anyone with a Bloomberg terminal and a charter to run a gigantic carry trade that should be symptomatic prudential concerns? Any thoughts on that, especially Dennis, Aaron? Like, how do you think about macro concerns as opposed to micro prudential concerns?
So, I guess I would start by saying it's very interesting because when you read the history, there's kind of two different themes that come through in broker deposits. One is troubled institutions aggressively seeking broker deposits to foster the liability, their lending, right? Because this is the magic of banking. I take your deposits that are redeemable either on demand or at specific intervals on the certificate of deposits. I make longer term loans that are far less liquid. I have this maturity transformation. That's kind of the 1980s story that the chair started out with. Then you see in the current crisis, there was a high correlation. That was kind of the quote I read to her on the crisis. It wasn't necessary, because it also says, and other wholesale funding, right? Because the world has evolved, right? The world is deeply evolved, and I posit two major structural changes that didn't exist when this rule was come. One is interstate banking, and you just reminded me of that, Dennis, because I was thinking of your Dallas comment in 1980, and you said one that's geographically diversified, and I realized that was only within one state. Right? People forget that up until the 1990s, you couldn't effectively bank in multiple states, and that's a huge that's a huge difference. The second is the combination of commercial and investment banks. So before, you could have these sweep deposit relationships between an investment bank and a commercial bank, but they weren't the same entity. And this kind of, I think, gets to Shamir's kind of core point, which is like, if you're a wholly owned subsidiary of an IDI, you are not hot money that can run. You're on the sticky side. If I'm Merrill Lynch and I'm sweeping into Bank of America, that looked very different pre-crisis than today, right, where I'm on the same firm. And so I'm, to answer your question, which is always a dangerous thing to do rather than give abstractions and turn to the next person on the list, I think of this much more still as a microprudential thing. I'm nervous in general about macroprudential as kind of a way to talk intelligently about things that we're not going to really regulate. And so, and on the micro side, broker deposits have been both causation and correlation with problematic. That being said, what is captured in the rule as written in the 80s, what exists today now is different. And I kind of am drawn towards Dennis's sticky, not sticky framework. And then I think reasonable people can differentiate where they fall between those things.
And what's sticky for me might not be sticky for you, right? So that adds to the complexity. And I think, again, the macro issue is that we're mispricing risk, we're miscalibrating risk with this rule, and we're discouraging banks from raising stable, sticky funding with an outdated concept, and that's a statutory concept, right? So we're lumping, every deposit with a third party does not pose a hot money risk. And that's where we are right now.
Well, part of the
not all deposits are brokered, and not all broker deposits are bad.
Part of the problem is we're all going to find out after the next crash. And that's something we should all think hard about when we're talking about the trees or the forest. Because, look, there are a few industries that need more innovation and competition than the financial industry. I mean, I don't think that's disputable. If you look at the concentration and the poor incentives, the barriers to entry in the financial industry, it's hard to compete with them. But there's nothing worse for innovation than a crash, a crisis, or a scandal. And Shamir's comment about getting a bank charter in 2009, and why was that? Well, 2008 was the worst financial crash since 1929. It caused the worst economy since the Great Depression of the 1930s. Everything pulls back at that point, right? For good reasons, and maybe for some bad reasons, but mostly for good reasons. And so what we have to do when we're making policy or rules, and whether we're looking at the tree or the forest, is figure out how we really strike a balance in a way that achieves the statutory objectives which the chair and the FDIC has to do, irrespective of their personal views, and how that works in the overall architecture. But for me, when I think about this, the worst thing to do is to start calling, everything sticky money when the label doesn't change the fact that it's hot money. And 3, 4, 5 years down, and I'm not saying anybody's suggesting that. I'm not in any way. I think people have good faith arguments for what they want to do. But I think, the problem is that they're associated with profit maximization, which is perfectly legal, and we want that to happen because good things come from it. But bad things come from it when profit maximization drives policy and rules. And what you need is the balance, because in 5 or 6 years, when something blows up, then you're going to end up with an overreaction, and you're going to set back innovation even more. And we're going to be constantly in this cycle where we seem to be in too often, and you and I, unfortunately, have been around long enough, and not you, obviously, but your father, that we see these cycles of where you kind of have open regulation, something happens, boom, it gets closed back down, and then it's got to come back, and then boom. And what we need, and that's why I say we need this balanced regulation where you're, particularly when you get anywhere near OPM, other people's money. When you get near other people's money and those people are taxpayers, then the sensitivity to that should be higher. If you're in the non-insured depository arena, then the concerns can be low. If you want to lose your venture capitalist people money, I don't mean you want to. If that happens, I feel bad for those people, but they've got a portfolio and they're going to be fine. When those risks and those costs are shifted to the taxpayers in Main Street, then the consideration for them ought to be commensurately higher. And so when you're looking for the balance on the spectrum, the analysis isn't always the same. Sometimes if you're out of the banking system, higher tolerance for risk, higher tolerance for loss, because you and your funders are going to bear the loss. When you're over here in the insured depository and where taxpayers are going to bear it, then higher goes the consideration for them. And then somewhere along that spectrum, you end up with a balance. And that's what we should look for. And right now, the balance is out of whack in the overall regulatory architecture. It's all going towards industry asks, industry gets. And we're all going to pay the price for that, no matter what your views are. I mean, if you believe, we all believe in innovation. We all believe in progress. And if we want to have that materialize, then we need a set of rules that are going to work over time.
So I'll answer Raj's question, but just before that, I'm like, this again such a day of firsts for me, because I'm like, this is probably the first time anybody's ever called me part of the industry in my career. So it's quite interesting.
You've made it.
Oh no, I view this as a failure. So I do agree with Aaron that this is maybe Chairperson Williams' approach on this particular topic of let's put it all on the asset side is maybe a better approach. There's almost anything you could do would be better than what we have now. Because right now it's a mess that only favors the large banks. I should point out that the existing brokered deposits, which are all, as you said, sitting with the large banks, none of the fintechs I know keep any deposits at a large bank. In fact, they all keep it at small community banks because those are the only ones who will work with them. The big banks view them as the enemy, not as the friend. So the only people who are actually getting screwed really by all this mess of the existing brokered deposit is not Chase or Bank of America. They still get all their brokered deposits, as you pointed out. The ones who are getting screwed are people like me or the companies that Raj is now investing in, right? And so the system I don't think there's any way of kind of finding where people are on that spectrum of sticky to hot deposits without doing micro-prudential, right? I mean, either you don't do it and you just say we're going to trust the asset side and we'll be fine and we can ignore this problem, or you say belt and suspenders, but then if you're going to do something about sticky versus hot, then you're going to have to do it micro-prudentially, because any kind of like bright line you try to draw anywhere, some smart lawyer or consultant will find a way of getting around that. And guess what? When it comes to hiring smart lawyers and consultants, the big banks do a much better job of it than us fintechs, right? We do a better job of writing technology. So I think the only way to do it is to do it micro-prudentially, understand that, of course, if every examiner was perfect, then we would never have any problems. Reality is, examiners are going to make mistakes. Let's do it transparently. Let's try to stick to one set of standards. Let's learn from it and let's evolve. And I liked Chair McWilliams' approach for that too. But I do think there is a macro piece here, which is also going back to your thing, Aaron, is that the world, like, you cannot stop an idea whose time has come. Right, like nobody, like no matter, like the entire regulatory apparatus of all the governments in the world together will not be able to stop innovation. Maybe for a generation or two, right? This is financial regulation. Money is way more important than ads or any other part of technology. Money has also been the first buyers of like the early UNIVACs were all like financial institutions and the Department of Defense, because guess what? Back in the 1960s, a computer was a job description for a person who added up numbers. Where did all these people work? at banks because they had to add up numbers. Thankfully, banks were mostly state or county level institutions, so they didn't have to add that much up. But getting getting a financial report of a bank's balance sheet at the end of a month took hundreds of people adding stuff up on paper general ledgers. As soon as there were computers, banks started fixing that stuff, right? So this wave of technology has been brewing in the financial system. The whole tech industry, all these ad startups are the new ones. Banks adopted mainframes back in the 70s. So that has been brewing, and that is going to change the world. That cannot be stopped. And the only question is, how well can you get ahead of it? And there are many different ways, right? Like if you don't like fintechs operating as brokered deposits in working with a community bank, maybe you should just give them charters and say you get to go be a direct bank. But if you're going to block one route, understand that they will find another way, and the innovation will happen. So I think reflexively kind of trying to say the existing system is better and screws screws over the small guy. When we started Simple, I had like 10,000 email conversations with potential customers, right? None of them knew anything about banking. So I've spent a lot of time trying to understand the small guys, and a lot of what Aaron says resonates with me. But the future is going to be people like me.
I just don't think it's either or. I think it's both. I think you can have innovation and you can protect the deposit insurance fund and taxpayers. And I think the constant characterization of one or the other is just a false choice. And I think it's difficult and it's messy and it's complex, but you can have both, and we should have both, and we should expect both. And that's ultimately where we need to get.
So
Totally agree.
if you ever asked yourself, can I sit in a room and talk about broker deposits for 2 hours? The answer is yes. Join me in thanking the panelists. And thank you guys for engaging in this conversation.
And thank you, Brookings
Thank you,
and Aaron.
Aaron.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.